Thanks so much for tuning into this earnings conversation with Amit Chadha of LTTS. I'll read out a comment from Morgan Stanley Note, which says that the results were better than expectations and the management commentary was balanced on demand, but the cut in revenue growth guidance was a negative surprise. Let me get in, Amit Chadha, to talk about all of these aspects that this one statement in a nutshell encapsulates, if you will. Amit, good having you. Thanks for taking the time out. I hope all is well.
Yes, good morning. Thank you for having us, and a very happy Navratras to you and all your viewers. All yours, sir.
Thank you so much, and wishing you and the team the same. Amit, there are positives, there are negatives. As is my want, I'll start off and get the negatives out of the way first.
Sure.
One thing that I noted was the cut in revenue guidance. Actually, that was probably the only one negative, because on headcounts, on attrition, on margins, you've done very well. So I'll come to those. But the guidance, why this pullback?
So thank you so much for having me. And so let me start by saying that, look, we remain cautiously optimistic, right? Optimistic because of the ER&D space, the spends that we see that are going to be coming out. Cautious because of current global environment, if I may, right? There's nothing else to it. When we started in April and we gave our guidance of 20% plus, at that point of time, we didn't have the current macroeconomics that are there today. We did bake in some of it, but we didn't bake in, for example, the UAW strikes. We did not bake in what's been happening recently in the world. So all that was not baked into it. And we thought at this stage, out of caution, it's better to come in and revise this right now than come in January and say sorry. So I'd rather err on the side of caution but still be optimistic. So I would say what we've guided you right now, 17.5 to 18.5. And our goals, of course, are to do better than that, or at least come in at the upper end. But we continue. The year is not done yet. We're just 6 months into it, and we'll see where it goes. And not just that, I do want to add that when I had spoken to you last time, we were seeing decision delays. And I had told you at that time that the number of deals that we've got in the pipeline are far greater than they were same time last year. Well, with that, we've been able to sign about 10 million plus deals, out of it 6 are near 20 million. Couple of them just above, couple of them at 20, and couple of them below 20, so around $20 million. And not only that, in the first 3 weeks of October, we've signed a 10 million plus cybersecurity deal in the US. In addition to that, 2 more 20 million plus deals, one of them in the next-gen comms area. So I'm fairly comfortable, if I may, with the deal wins that we've had. Just that it's going to take time to ramp all these up. And then, there's a Q3 seasonality that always is there. But the year in progress and year to be played out.
Got it. And I have follow-up questions on these, but let me first address the positives as well, Amit, which is that the revenue growth number looked good. The margin performance looked solid. And contrary to the whole chatter around how IT services have come off on the headcount and are retrenching people, I see that not only has your attrition looked good, but you've also added headcount. Talk to us about the positives as I see them, or as you see them.
Sure. So as I've always said, Neeraj, that we are an engineering and technology company, and we continue to make investments in latest new gen areas. In fact, if I look at my revenue mix today, as opposed to what it was, say, 3 years ago, about 60% of the work that I'm doing today did not exist between 3 and 5 years ago. The skills are more or less the same, but you've got to be able to upskill people, etc. So what we've done is 2 or 3 things. Number one, make no mistake, we continue to be very frugal in spending patterns. In fact, not just that, we are again, for the next 6 months, we will again go into a period where we don't want to spend where we don't have to spend, right? These are your SG&A and other expenses that you continue to do. So we are fairly clear and frugal in that area, and I'm proud of doing that. I mean, there's nothing wrong in it. At the same time, we are not cutting any expenses towards our investments in SDV or AI. In fact, there's about a 2,000 member team that's getting ready in that area. And that for us will mean hardware, embedded layer, the software layer, and the data layer. So the entire 4 areas we are investing in already. The first batch of 350 people are more or less done. Remaining will get trained. People have been identified. Curriculums have been fixed, etc., etc. So we are seeing continued investments, if I may. We've in fact set up a couple of new labs for AI. We've leased out some infrastructure that will help us in computing and looking at various large language models. So we continue to make those investments. So it is balancing all this out, if you ask me, that we need to continue to do, and that's part of regular operations for us. And we are very conscious of making sure that we stay in that 17% band for now. If you'll remember, prior to the acquisition, we used to be at about 18.5+%. And with the acquisition, we had said that we'll come in near 17. So we did beat the expectations last quarter. We were at 17.1 to 17.1 last quarter. We will stay in that 17% bridge. Let's stabilize in that. Let's continue to make the investments and then move to the 18%. But I would not run towards providing more profits. I would rather continue to invest in the business and do it in a balanced manner, if I may, as we move forward. We've also issued interim dividend of 17 rupees. So I do believe that we need to take care of all the stakeholders as we move forward.
But that's an interesting theory to follow, Amit, at a point of time when the world seems to be for lack of a better word, in a state of imbalance, geopolitics notwithstanding, even growth. Europe is faltering. Asia is not having the prettiest of times, save for voices like India and Japan. The center of growth, of course, US continues to look okay, but a lot of other geographies aren't. So is it a prudent time to go behind investing heavily, or as part of you said, trying and be very conscious on cost because the times look uncertain?
So you've got to do this in pockets, if I may, Neeraj. There are areas where you need not spend that amount of money because you already got them established, right? So think about the business as being 2 or 3 pockets of business. There is the new gen, next gen business that does require additional skills, does require upskilling, that does require investments. There's the stable business that is now delivering, right? And is like an engine. And then there's a commodity part of the business that needs to actually, if you ask me, deliver higher margins because it's not going to grow. So you can't. So the way we look at the world that we operate in, we look at, either there's people, there's technology, there's clients, and then there's top line and bottom line, right? So you have to deliver. So people, clients, everybody, all our businesses need to deliver. We've got 12 business units within the company. All 12 need to deliver to employees and customers, right? That's a given. Beyond that, you can come in and say, I'm going to develop the patents and I will not be able to give you the margins right now, but I will, at the end of it, after my patents and all this is done, I will convert that and I will be able to give you top line and bottom line. Or you can come back and say, I'm done the patents. Now I'm going to focus on top line and bottom line, or come back and say that, look, my top line is flat. Patents are done. The technology area, everybody knows. I will focus on the bottom line. So you will need to, my belief is you need to tick 2 of the 3 boxes for sure. And then you're okay. And we live in a very different time. There is limited dollars. I mean, there are decisions that we make that say we're going to push so and so thing out. Like last quarter, we decided that, look, it was unfair to employees. We knew the macros were worsening, but we said it's unfair to employees if we don't do the increments. So we went in and did the wage hikes. But at the same time, we are pushing utilization within the company. So we have taken 500 plus net people, but I'm very conscious of the fact I don't want utilization to drop. So there may come a time where I'll say I won't hire for a quarter, or I will not do any net hiring in a quarter, but I will focus on improving utilization. So various levers, look at it at the end, look at top line, look at bottom line, look at attrition, look at number of patents. That's what I would focus on, if I may, and deal wins, because that tells you the future.
Yeah, sure. I mean, please don't mind. I was not trying to question your decision. You run the company successfully. I was trying to evoke this answer from you. So thank you for giving us that perspective.
I thank you for asking it, because, at the end of it, you keep thinking every day and you balance it out. And I will be honest, there's no silver bullet and there's no crystal ball. You continue to learn, you continue to operate, and you continue to improvise.
Okay. One quick perspective, Amit, from you. I'll take 2 more minutes of your time. One perspective from you. I asked this to IT services companies that the deal wins seem to be strong. I know you're different, but I'm still asking you from a perspective of a tech company, if you will, that the deal wins continue to be very strong for a lot of companies. It's not quite translating into the similar kind of revenue growth or even indicative revenue growth. In a lot of companies' cases, the guidance cuts are very heavy as well. So where is the dichotomy? If the deal wins are so strong, why is it that the revenue growth numbers or the guidance are looking shaky, if you will?
So the two or three things happening, Neeraj, that we got to be cognizant of. Number one is that the deal wins that are happening have higher tenures and lifespan as opposed to what they were a year ago, right? With us as well, right? So where the deal win average used to be 2.5 years, 2.7 years, now the average is about 3.2, 3.4 years. So it's slightly longer deal wins that you have, number one. Number two is some of these ramp-ups are staged, if I may, over periods of time and not overnight, right? Like we got this 50 million deal last quarter, that's completely ramped up. But there's a couple of others that we had that were 10 million plus, and they said, go a little slow and let's get full potential of this coming out in quarter 4, right? So that's number two. Number three is there is legacy spend in all businesses that will go away. I'm not going to make any bones about this. This is reality. So unless we continue to invest, so if you are a tech company, you've got to continue to focus on next-gen technologies and next-gen areas. Otherwise, you will continue to have the problem of legacy spends continuing to go down, people shuffling dollars like we do in our businesses, and that is what you're seeing right now play out. In fact, I did want to give you 2 data points. I'm going to switch for you, if you don't mind. One, there's a latest report that's come out that talks about ER&D spends right now, going from currently at about $280 billion globally in 23 to going to near $750 billion in 2030, right? ER&D to India, which we had talked about last time because of the C+1 movement and the RUB going away, etc., was at $45 billion between global competency centers and companies like ourselves, and is expected to go to $130 to $170 billion by 2030. Again, latest report just came out in October. So very interesting to see about the future. Not just that, the same report talks about 70% of respondents in a survey saying that they believe that ER&D spends will either increase or stay the same next year. There is a 30% population that says that they will either increase or decrease or stay flat. But there is that bit that's there out there. But like I said yesterday to somebody, that the year is still to play out, just quarter 2 done yet. So an unfolding story, if I may, but cautiously optimistic.
Yeah, and that stems from your last answer and your first answer. I understand you're short of time, so I won't ask you. I'll save this question for the next interview, Amit, because I would love to understand what's happening with the different centers that you opened across the world, across different kind of skill sets and the experience thereof. But we'll talk about that the next time. For now, because I understand you're short of time. But thank you so much for taking the time out today, Amit, and talking to us.
Thank you. I appreciate it. Thank you so much.